Hello, and welcome to the August edition of the Economy Watch webcast series from the Conference Board. My name is Eric Lund, and today we're going to be examining the impact of the COVID-19 pandemic on two countries, Turkey and South Africa. The primary questions that we're going to hope to address over the next hour include how has COVID-19 looked in Turkey and South Africa, and how has it impacted business operations in the region? How have leaders in these two countries responded to the pandemic? How have the economies of these two countries been impacted, and what kind of a recovery is likely? And how do South Africa and Turkey fit into the global economy, and what are the risks that they both face from external COVID-related impacts as well? As always, we offer CPE credits for joining the webcast today. You have to stay on for the entire duration of the webcast. I believe there are 3 pop-up boxes that you'll have to click as well, and you have to enter your name and, I believe, email address at the bottom of your screen in the small window. We're quite fortunate today to have some fantastic guests to tackle these topics. First, joining me from inside the Conference Board is Ottoman Özildirim. He is the Senior Director for Economic Research, and Ottoman's going to be talking to us a little bit today about the Conference Board's global outlook. Also joining us from Cape Town, South Africa is George Kirchhoff. He is the Deputy Director for the Bureau of Economic Research in that country. And we're also joined by Aisha Imrohor-Olo, who is a professor of finance and business at the Marshall School at USC in Los Angeles. Aisha, George, thank you so much for joining us.
My pleasure.
So as we do every month on this series, the first stop, so to speak, is an update on the Conference Board's most recent U.S. economic forecast and some of the things that we're looking at here domestically in the U.S. As is the case in most places in the world, before you can really start talking about how the economy is performing, you have to take a look at what the virus, COVID-19, is currently doing in any given place. Over the summer, especially early in the summer, we were in the U.S. seeing a pretty large, substantial increase in the number of new cases. For the most part, these were taking place outside of the original impact zones. So, for instance, here in New England and in New York, the biggest number of cases really surged in the April-May kind of time period and then ebbed. And we've seen an increase in the number of cases more recently in states that weren't impacted at first. So places like Florida and Mississippi and Arizona have been the hardest hit. That having been said, we have not seen a large lockdown in the same way that we saw earlier in the year. Instead, what is taking place is individual states are addressing these surges with their own sort of local policies. And this seems to have worked if you look at the more recent numbers. The spike that we've been seeing in cases has been ebbing down, and this is a result, we believe, of effectively addressing the pandemic in some of the states that I just mentioned. That having been said, we're certainly not out of the woods. We're not even close to where we were just a few months ago in terms of new case numbers, and there still remains a lot of work to be done to try to address the degree of the pandemic and how we're grappling with it here in the U.S. We've also done some work recently on trying to think a little bit more about how these sort of state-by-state flare-ups impact the U.S. economy as a whole. And so what we've done is we've taken a look at sort of the importance of each individual state in the U.S. economy more broadly. You can see that here as represented by the blue bars. The larger the bar, the larger the amount of output from that state, and the more important it is to U.S. GDP at large. So you can see here New York, California, and Texas are pretty much the 3 largest, but certainly other states in aggregate are critical to U.S. GDP overall. Now, we've juxtaposed this by trying to get a sense of what COVID-19 looks like inside of each of these states, and that's represented by the red dots that you're seeing. These are positivity numbers. A positivity represents the share of tests that are given that come back as positive. So as opposed to just looking at new cases, which can be biased perhaps by the size of the population within that state, we're looking at the actual number of positive cases given the amount of tests that were actually given. And so we can see here that the positivities range from close to 0 all the way up to close to 20% or so. You can see that on the right-hand side on the y-axis. So we rank these to get a sense of who's doing the best and who's struggling the most. And we've also integrated these three sort of colored areas, green, yellow, and red. The WHO recommends to various governments that they should not engage in reopening activities unless the positivity rates are at or below 5% for 14 consecutive days. So as you can see, given the positivity rates that we're currently seeing, only maybe 10 to 15 states in the U.S. currently sort of qualify within that WHO recommendation. And that only represents about 25% of U.S. GDP. If you look at positivity rates between 5% and 10%, again, this is higher than the WHO recommendation, that constitutes about 45% of U.S. GDP, and about 28% are above 10% positivity. So the states on the right-hand side, that roughly 25, 26%, represents the most at-risk sort of slice of the U.S. economy at present. I also wanted to briefly touch on some of the higher frequency economic indicators that we track throughout the Conference Board. We track quite a few, but there's just a couple I wanted to touch on. The first is the top left. These are initial claims for unemployment. There has been progress made on this. There was, of course, a massive spike that we saw in March of earlier this year that's come down. But that having been said, we haven't come back down to the same levels that we had seen prior to the pandemic. So there's still quite a bit of work to do in terms of addressing unemployment, which hovers at this point between 10 and 11%, depending upon how you count it. So there's still quite a bit of work to be done in that area. On the bottom left is a chart that shows U.S. consumer confidence, which is the blue line, and U.S. CEO business confidence, which is the red line. Both of those have come down substantially from where they were in December or in January earlier this year. They've stabilized. They're not going down further, which is good news, but they still have quite a bit of progress to come back to where they were. On the top right, we have consumer spending, personal consumption expenditure. The blue bars are the levels, and again, those have come down substantially and then risen, but they're still quite below where we were prior to COVID-19. And then finally, within the manufacturing sector, on the bottom right-hand side, we take a look at industrial production within manufacturing, which is blue, and capacity utilization, which is an interesting number to look at, which is red. We're seeing improvement there, but not enough to be super optimistic about what is ahead of us. So before we move into our own outlook at the Conference Board, which we update every month, we wanted to get a sense of what you're thinking about the U.S. economy right now. So we have a poll question for you to weigh in on here. Given recent trends in COVID-19 cases and economic indicators, what are your expectations for the shape of the U.S. economic recovery? We have a couple different options here. I won't go through the long versions, but they are basically a V-shaped recovery, a U-shaped recovery, the swoosh-shaped recovery, which is a new sort of term that I think has been a little more popular this year, W, which entails another sharp contraction in the future, and then L, which is a recovery in which there is really no recovery. We just sort of move forward at a pretty anemic growth rate. So those are the options you have. Let's go ahead and lock that poll up if we can. Thank you. And we're closed. So it's pretty much a tie. It looks like about 40% of the audience is expecting a swoosh, and then a W is tied at about 40% as well. About 9% is U. A V is down at 7, and then an L is at only about 4%. So not a lot of awful pessimism. So the L shape is quite lowly ranked. Not a lot of extreme optimism. The V doesn't seem to have too much going for it. So more of a middle ground here. Ottoman, do you have any thoughts on what the audience is telling us here?
Yeah, this is very interesting. I think one thing that is a little bit surprising to me is that there's not a lot of support for the L shape. If you kind of look around, there seems to be a lot of pessimism in the media, but most people seem to be more leaning towards the options which give you a little bit of recovery, but not very pessimistic in the sense of another Great Depression type of environment. So that's pleasantly surprising and maybe a cautious outlook. Otherwise, I think this option for the W shape, which is kind of the second dip that might be coming ahead in the near term, seems to be a new option that's going to get a lot more attention, and we'll probably be hearing more about that going forward.
Aisha, do you want to weigh in a little bit? I know that you're based here in the U.S. In addition to having a great command of the Turkish economy, you know a lot about the U.S. economy as well. What do you think?
Well, it is really interesting because you probably noticed, all the economists started writing COVID papers when this pandemic hit us, and I ended up writing one as well. And one of the insights we got from that was even if the recovery starts, I think there is going to be a substantial amount of people who will be worried about going back to work, and they're going to be the ones who are vulnerable to this pandemic. So I think we already saw this at universities, for example. Universities initially said, oh, maybe we'll open up, but then a lot of faculty are older and they were at risk. So the prediction that we got from our paper was even if the recovery happens, we are not going to go up to the old levels. We're going to be below the old levels for a while. So I don't know what to call that one. There's no name for it yet. I'll have to come up with one, but it can be a V shape. Even if it's a V shape, it's going to be under the previous level is what we were predicting.
We have actually a question here from the audience talking about the potential for a second wave and its impact on manufacturing in healthcare and medical devices. I think that the way the U.S. has been addressing flare-ups, whether it's a second wave that's national or a big spike in places like Mississippi or in Arizona, I get the sense that the closures that we're seeing are more focused on industries that have a hard time implementing social distancing policies. So things like in bars, restaurants, concert venues, movie theaters, things like that. Whereas earlier in the year, there was more of a blanket closure across various industries. So it makes me think that the potential for an industry like manufacturing to sort of get through, whether it's a strong uptick or a second wave or whatever you want to call it, I don't know if those industries are going to be subject to the same kinds of closures and social distancing restrictions that other businesses are, because they're able to continue to operate even at a lower capacity while mitigating or moderating the risk levels.
I think that's the really unique feature of this recession, in that it's so closely tied to the public health aspects of the pandemic, and that requires that you shut down all this production activity. And then the more affected industries, even within manufacturing, are the ones where the production activity is happening, where you can't keep the workforce socially distant from each other. But to the extent that there are production, the way production is organized allows for more distance activity, then those manufacturing industries might fare better than others. An example is the sort of meatpacking, where it's impossible to keep the workers apart, and because of the kind of the cooler environment, the transmission tends to be higher. So there are very sort of unique cases related to the ability to keep social distancing.
Let's go ahead and, now that the audience has sort of told us what they think about what the future holds, why don't we discuss a little bit what we're thinking here at the Conference Board. So before I dive into the specifics, the Conference Board has been actually publishing scenario forecasts really since COVID-19 hit. We are offering at present, and more recently, base cases, but we're still offering upside and downside sort of paths to how things move forward. We've also started forecasting on a monthly, month-to-month basis. We're not looking at just individual quarters because the virus evolves so rapidly. It affects almost on a weekly basis. It's affecting various parts of the economy. But we've gotten more granular in our forecasts and are looking at sort of output levels on an industry-by-industry basis for about 15 different industries on a month-to-month basis. So it gives us the ability to be a little bit more versatile and flexible in terms of tracking how things are unfolding. And then, of course, we translate that into the more traditional quarterly growth numbers that you see, that you'll see in a moment. So what you're looking at right now is our current sort of industry-based month-to-month forecast that we've put out. The shaded area is the historic numbers. So we go back into 2019 and then look at how we entered 2020, the large decline that we saw in March and April, and then the recovery that we saw in May and June. So we have a base case, which is the black line as it moves forward. But I also want to touch on our last forecast, which was the blue line, which you can see was a lot more pessimistic. So we had assumed that in the second quarter, the growth rate was going to be even weaker than it actually was. The official number was a contraction of 32.9%, and we were at 38.9, so we were about 6 percentage points lower. We hadn't expected the economy to rebound to the extent that it did, especially in June. And so we're entering into the summer on a stronger footing than we had previously expected, which is fantastic news. We didn't think that things were going to recover as well. And so moving forward, our base case forecast is that, unfortunately, over the next couple of months, July, August, and September, we're expecting the recovery to flatten out quite a bit. As we went through just a few minutes ago, there are various flare-ups in a variety of bits of the economy. Some of the WHO recommended levels are much, much higher than we're seeing in places like Mississippi and elsewhere. And for those reasons, we're a little bit more cautious. We also expect the consumer to struggle a little bit more in the third and the fourth quarter. For the most part, when this pandemic first hit the country, it was a supply-side shock. So it affected businesses' ability to operate and to open. People stayed home. Business stores remained shut, whether you were manufacturing or in retail or in the services sector or in transportation and accommodation. And as a function of that, we saw the level of unemployment go up quite a bit. We think that this unemployment rate is going to sustain itself and that the supply side shock is going to transition itself into a demand side, more classical hit to U.S. growth. With consumption composing about 70% of the U.S. economy, that has real implications. And so we're expecting that the growth rates that we see over the rest of the year are probably going to be a lot more anemic than unfortunately what we've seen over over the beginning of the summer. So the base case forecast for the year at present is 4.9% annual growth. Moving into 2020, we think that the picture will improve gradually. We're not expecting a big rebound in the first or the second quarter, but a steady improvement, which yields about a 2% growth improvement. That having been said, in our last forecast, we were overly pessimistic, so we're offering an upside scenario as well here. That's the orange line. So if growth does continue to resume at a more accelerated pace than we currently forecast as our base case, we'll only see a contraction of about 3.3% for 2020, and then a more rapid recovery in 2021 at about 4.4%. So this is our industry-based forecast. We also actually, of course, map this to the more traditional expenditure approach to cutting up GDP. So here are the individual numbers. We see the rebound of about 26% annualized for the third quarter, and a contraction of about 1.6% in the fourth quarter. And then, of course, here we have the individual readings for 2020 and 2021. I'm not going to go into the detail of all these individual components as I want to get to the main topic today, South Africa and Turkey. So I'm going to pivot and let Ottoman give you a brief update on the global outlook that we have at the Conference Board.
Of course, we go into some of the details about individual countries. Maybe it's good to get that global context in mind. We have our global economic outlook. We're actually going to do our annual report later this fall. So a lot of this discussion is kind of feeding into that. But the current view of the shape of the global economy is pretty similar to what you've heard about the U.S. Even though sort of individual countries, of course, have very different case-by-case differences. But what we've done in this chart is to compare the view of what's happening to mature economies and emerging economies. So mature economies in blue and the emerging economies in the orange line. And we've compared those to what they went through with the Great Recession that we saw in 2008, 2009. We talk about this being a very unique recession. It's really resulting from the pandemic and the supply shock that's related to that. So it's very difficult to make these comparisons. But we do have a very large contraction, especially for mature economies in the 2008-2009 great financial crisis. And you see here how that compares with what we've seen already in the first half of the year, a very deep contraction, which is also affecting emerging markets. So the whole world economy is really undergoing in a very synchronized way. And we used to think that the 2008-2009 period was a very synchronized contraction, although the emerging markets fared a little bit better, relatively speaking. So again, a much worse contraction for the global economy. And there's really no way to, in a way, hedge your bets by shifting your focus or shifting your revenues from one economy that's in a bad shape to others where they might be doing better. So everybody's in the same boat. And you see that it does take a very long time for the global economy to get back to where we were at the beginning of 2020. So emerging markets might reach there a little bit earlier. I think China's recovery plays into that quite a bit. But even there, emerging markets, you see how much lower they are compared to their recovery in the in the 2009, 2010, 2011 period.
And Ottoman, I'm going to jump in for just 1 second. We did have a question about China and about their ability to tackle this. You just mentioned China, so I thought I'd just interject for a moment. In terms of their ability to successfully moderate the spread of the virus, I think it has to do with the way society is structured in China, the strength of the government. In a democratic system with a little bit more liberal sort of social policies, people are free to not do what they're told. We actually have a chart later on that shows the divergence between these policies, COVID-19 policies, stringency index, and what people actually do using Google mobility data. So you can see there's a divergence there. People don't always do what they're told. In China, which is more an authoritarian country, the government's stronger, people's rights are weaker, and as a function of that, if the government says stay home and wear a mask, people stay home and wear a mask. I think that's one of the primary reasons that they've been able to successfully tackle this.
We actually have another chart that's coming up that shows the view from China. So in this chart, what you're seeing is what the economic data is showing us and what economists are thinking about the future path. But being a membership organization, the Conference Board has a lot of business members around the world, and we ask them what they think, and that's what we'll see in the next chart. If you can go to the next slide. Our C-suite challenge survey asks business leaders around the world what they think about economic trends, business trends. We usually do this annually, but of course in these days of COVID, we did a special mid-year survey, and we asked the same questions that you were just answering about the shape of the recovery. We had about 1,300 executives around the world responding to this survey. It was fielded in the first half of June, and about 900 of those are CEOs, and most of those CEOs, the majority, is expecting a prolonged U-shape, similar to what responses that we saw there. And in this chart, you see how that's broken up geographically for U.S., Europe, China, Japan. We get a lot of responses from Chile and the Gulf countries, Kuwait, Saudi Arabia, and so on. So globally, most of these CEOs are expecting a U-shape, very little support already in early June for a V-shaped type recovery. The L-shape, the really prolonged, more depression type of scenario is getting some support with 20-25% responses there too, as well as the W-shape. I think we should kind of keep an eye out for those since the environment is really tied to the risks from the pandemic. The difference there that you see, the last thing I'll point out on this chart is the Japan and the Gulf countries are more pessimistic. Those CEOs are really thinking more of an L shape, where the long-term path of the economy just kind of takes a dive down and stays at that depressed level for a long time. That may be because of the specific nature of the Japanese economy, or the fact that they're much more globally exposed economies, and they're really affected by the global environment. And as we've been talking about, the global environment is going to take a long time to dig out of the hole that we find ourselves in. The next chart, this chart was asking about the overall economy, but in the next chart we are asking about what they expect about their own company's revenues in terms of the recovery back to early 2020 levels. And there the options are kind of the progressive periods, the first half of 2020 before July, the second half of 2020 before December, and the same thing for 2021, the first half and the second half. And there you see much more optimism about their own organization's revenues recovering in China. In the second half of 2020, they're already recovering to pre-COVID levels. Whereas in the U.S., for example, the purple line, the U.S. CEOs think that that's going to take much longer into the second half of 2021. Overall, globally, the revenues are expected to be recovering in the first half of 2021. And maybe the last thing to point out is that there are some industries and sectors where they haven't seen any decline in revenues, and although that is a very small share, 5 to 10%, if you look across all the industries, and some have already recovered. So those are the industries that are really, whether they're providing essential services, groceries, or utilities, where you don't see that type of decline in revenues, but they're not really enough to offset the negative contraction that everybody else is feeling.
No, and we had a question about that earlier on in terms of the upside that some industries are facing, and it's simply not enough to counter the downside that others are facing. But I want to move ahead if we can. We have these two great guests, and I want to get as much out of them as we can over the next half an hour. So we're going to start talking a little bit more about this experience from the perspective of Turkey and from South Africa. Before we get to the content and the speakers' views, we're going to go ahead and poll you again to get your perspectives. A lot of you aren't experts on Turkey or South Africa. Certainly I am not. But why don't we talk a little bit about, from a company perspective, what maybe you're thinking about in terms of potential FDI destinations in the future. So as large international companies reconsider their global footprint following COVID-19, how attractive are Turkey and South Africa as potential FDI locations? We have 4 different options here. The first is that both South Africa and Turkey are attractive. The second is that South Africa is attractive, Turkey is not. The third is that Turkey is attractive, South Africa is not. And the last one is that neither Turkey nor South Africa are attractive FDI locations. Now, of course, this is going to depend on what kind of an industry you're coming out of. Certainly somebody in manufacturing versus services versus transportation, everyone's going to have a little bit of a different perspective. But it's interesting exercise to see what you all think. So let's give you a few more seconds to weigh in. And if we can, let's maybe lock up. All right. So it looks like South Africa has a bit of the edge. About 38% of the audience think South Africa is an attractive location. Turkey, not so much. About 23% think that both Turkey and South Africa are attractive. Only about 5% think that Turkey is attractive and South Africa is not. And about a third, 33%, don't see either one as attractive. And of course, this depends on the footprint of the company involved and the nature of the industry, of course. Interesting results. Ottoman, maybe we can start with you just briefly, 1 or 2 minutes. What do you think about the results?
Well, I think in terms of investment location, there's a lot of sort of different factors that are playing into the macroeconomic performance of those countries is an important aspect, and South Africa and Turkey probably have very different profiles with respect to sort of the macro stability, and perhaps that's a reflection of why there's a sort of more disagreement across the different investment locations.
No, that makes sense. George, what do you think as the winner here? What are your thoughts on the outcome?
Yeah, I'm a bit surprised. I would have expected a much poorer performance for South Africa, but perhaps I am too focused on all our problems and I am unable to see the country from abroad. So, but after my thoughts, perhaps people will change their minds and South Africa will get a lower rating.
No, that's not the goal. The goal, George, is to get the higher rating. Aisha, as a professor, you know how this works. You want to get the best grade possible. What do you think of the score that Turkey got on the poll?
Well, I think it's actually consistent with there has been quite a bit of decline of foreign investment in Turkey in the last, let's say, 5 years. So this is probably reflecting that sentiment. Okay.
Well, let's go ahead and move on. We want to get into the real meat of this portion. We want to go ahead and start out by, as we did with the U.S., talk about the experience in both countries with COVID-19. When did it take hold? What does the pandemic look like? Where are the case numbers now? Maybe you can spend 3 minutes, Aisha, just giving us an overview of what this pandemic has looked like in Turkey.
So there were a few things that Turkey did really well during this pandemic, so I'd like to start there. Many economists have been writing about targeted policies during the pandemic, and I think Turkey is an example of using targeted policies. And what I mean by that is that they Do you remember, like at the beginning, we were very worried about flattening the curve so that the hospitals are not overwhelmed. And the way Turkey did that is they said anybody over 65 is going to stay home because they are the most vulnerable population. And they did. I mean, my mom is 86 and she stayed home, and it became super easy to order online and have a life with all the necessities coming to your door. And that's not very sustainable in the long run, of course, but it did help flattening the curve. So the cases in Turkey are low, as you can also see from that graph. They went down quite a bit in May. There's a little bit of an uptick now, so people are again worried, but they are all wearing masks. Well, I shouldn't say all, but there is quite a bit of following those kind of rules going on. So if there is not a second wave, then it will be a success story, I think, the way they did the targeted policies. But you never know with a pandemic. There could always be a second wave. But so far it has
so many question marks. Absolutely. George, can you tell us a little bit about South Africa and how COVID has spread in that country?
Yeah, the first case was registered on the 1st of March, and in less than 3 weeks after that, the government introduced a full-scale lockdown for 5 weeks. Despite that, the virus has spread quite aggressively, but in June, July. So it is later than it hit America in March, and then April, May in South America, and now it is clearly in Africa. We have at the moment 570,000 cumulative positive cases, which makes South Africa the country with the fifth highest number of positive cases. And that sounds quite scary if you think we have a population of less than 60 million. Despite that, South Africa's death rate is surprisingly low. So over 5 months, we have only had 11,000 deaths, which is equivalent to about 1 week's normal deaths, if I can be so crude, in the country. And it is, people ask why. I think one of the main reasons is certainly it is a very young population on average. So 70% of people are below 40 years of age. The average age is 27, and we know that these people are less vulnerable. And despite the high prevalence of HIV and TB, it didn't turn out to be a comorbidity as high blood pressure or diabetes. So that was also a relief. It is clear that the case numbers, the new case numbers are coming down, and the statistics are also for an emerging country quite reliable, because if we look at the actual recorded deaths, that is about, at the height in the end of July, was only 5,000 more than in a week than it usually is. So it isn't that there are a huge amount of COVID deaths that are not recorded.
Thank you, George, for that perspective. That's great. I know that both of you have already touched a little bit upon government responses, and I mentioned these charts earlier in the webcast. What we're looking at here are a snapshot of Turkey and South Africa from two different perspectives. The gray line is something called a stringency index, which is an index that was developed at Oxford University to get a sense of what the government and social policies, how severe those are from country to country. So closing of restaurants, closing of schools, banning of concert venues, of large events, things like that. Those result in a higher stringency reading. We have it inverted here, so the lower it goes, the more severe the policies that have been implemented by the government are. And co-located on these charts is an orange line, which is data from Google, from their cell phone systems. It's called Google Mobility Data, and it gives you a sense of how much people are actually moving around. when it goes down quite low, it means people are staying home. But when it starts to pick up again, people are going out either shopping or for hikes or to the beach in South Africa, I imagine, although not right now because it's quite cold. So what are both of you talked a little bit about how the government had implemented these kinds of restrictions. Have they been lifting these restrictions? To what extent have the populations been compliant? And what are your expectations for these kinds of restrictions over the next a month or two? Aisha, maybe you would want to start.
So, their nature has changed over time. So, for example, the restrictions on 65 and older have become much more lenient now in Turkey, but wearing masks have become mandatory. So you can actually be fined for not wearing a mask. So I don't know how much the stringency index weights different measures that are taking place. I can imagine that, given that people are now allowed to go out more if they're wearing masks, you would see the Google measure change relative to the stringency index probably. So I suspect some of that might be.
And George, yesterday when we were talking, we talked a bit about the divergence here for South Africa. What can you tell us about that?
Yeah, I immediately thought it proves non-compliance, but I've given it some thought. There are certainly a measure of non-compliance. It is so encouraging to hear about the targeted measures in Turkey. Here it is much more blunt, and some of the measures are plain stupid. So, for example, initially you could only order takeaways delivered to you from a restaurant. Now you have sit-in facilities already. You may go to a casino, but you are still not allowed to visit somebody else, a relative or a friend in his house. So I think people think this is just crazy, and they feel it's safer to visit somebody at home. Also, which is ununderstandable, is that minibus taxis are allowed now to 100% load capacity. That is way more dangerous than anything. But I also think people have gotten over the first big scare, and although the stringency have not changed much, schools are mostly closed, you are forced to wear a mask in public, people tend to keep social distance. I think they feel safer and move around in parks, go out, so that explains part of the increase in the mobility, although the stringency hasn't yet changed.
Okay. I want to pivot a little bit and now start to talk about the economy in both of the countries. But before we get to what is unfolding currently, I think it's interesting and important to try to understand what kind of a footing Turkey and South Africa were on entering this crisis. Aisha, can you tell us a little bit about the performance of the Turkish economy leading into COVID-19?
So the last 3-4 years have been challenging for Turkey. 2009, as you can see, 2018, 2009, there's a big decline in GDP growth. And the Turkish government tried to fight this recession with increasing credit, lowering interest rates, and public spending. And this has, I think, put some strains on the ability to fight the COVID crisis on top of the 2018-2019 crisis. So I think you are seeing some strains in Turkish economy right now. For example, if you look at the exchange rate, Turkish lira has been declining steadily in July. And that's partly because the central bank has been trying to keep the value of the lira pretty stable for the last several months, while lowering the interest rates at the same time. But that can't last for too long. You can't have inflation and low interest rates and also stable exchange rates at the same time. So right now, Turkey is going through some turmoil in terms of what's happening in the exchange rate market. So there's got to be some changes that we will be seeing in monetary policy, I think, in the coming months.
George, what about South Africa? Where were you last year? Where were you the year prior to that? What kind of trend was the economy on?
The situation in South Africa is very similar to that in Turkey. After the great financial crisis in 2008-9, South Africa's growth rate generally were much lower than the 5 years preceding the financial crisis. So it slowed down from 4% on average to 1.7%. And the last 2 years was also very difficult, and it is due to different reasons. You know, the global economy was slowing, except for the last 2 years. There were clear signs of a pickup, but South Africa didn't follow that trend. There was a divergence. And then there were local domestic reasons. The prime one was certainly policy uncertainty. And then we also have electricity supply problems because of the big change in the monopoly that provides electricity in South Africa that are replacing smaller old power stations with new ones, and so there are on occasions blackouts, and this really dampened activity. So when the COVID crisis hit, South Africa was faced with, in a sense, 3 sudden stops. The one was the stop in the world economy, and for a small open economy in South Africa, that is a big thing. Just before the COVID crisis hit, South Africa lost its last investment credit rating. So for South African bonds in local currency were no longer regarded as investment rated, and there is capital outflows with that. And then obviously the lockdown was a full sudden stop in economic activity. So we started on a very bad foot when the crisis hit.
So in terms of looking ahead, the Conference Board makes projections for over 100 countries around the world. Ottoman touched on this earlier on when examining our outlook for developed and emerging markets. But we actually have individual projections for the South African and Turkish economies, which you can see here. They've been indexed to 100. Does this kind of recovery path make sense to the two of you? Are we being too pessimistic or too optimistic? What are your thoughts on the shape of the recovery in Turkey and in South Africa, and what we can expect over the coming quarters? Aisha, would you like to weigh in first?
Yeah, so I've been looking at some of the more frequently announced data to understand what might be happening, because it's so hard to do forecasts, especially during COVID. You know, it really depends on if there's going to be a second wave or not. But I've looked at numbers like electricity use, because that comes out weekly, confidence index of different groups. They seem to have recovered quite fast in Turkey right now. So if that's an indication, then I would say we could see a much faster recovery in Turkey, not compared to South Africa. I don't know South Africa data, but compared to what I used to think about what's going to happen. But it, again, depends on if there's a second wave or not. I think if not, and if Turkey solves its currency problem with the central bank, then I would expect a fast recovery.
George, what about South Africa? What kind of a recovery are you expecting?
Yes, your figures are not far off, I think, if I look into what the consensus say. Our own view at the BER is that we will have a deeper contraction this year of minus 8.7 and a much shallower recovery next year of 2.6%, and that the level of GDP will only return to pre-COVID level in 2025. So it is a very, very weak recovery. And if we speak more about longer-term growth trends, I'll explain that. But here you show the GDP numbers, but the other side of it is obviously what has happened to employment and unemployment. South Africa already has quite a high unemployment rate of 29% to 9%, and we expect that to jump to 38% by next year. So it is a real social crisis. Also, surveys indicate that despite the fact that the government increased social spending, cash transfers to poor households to make up for the loss in income, the number of people that went hunger in the evening went up to up to a fifth of people say they suffer from hunger. So it is, for an economist hard to weigh up these consequences vis-a-vis the death toll. But it is, and it has affected obviously lower income people, women more than it has affected professional people and those with high income. So obviously it affects the income distribution as well.
Yeah, we have some data on income as well. This is looking at income per capita relative to the United Kingdom to give a sense of how these different countries are in terms of catching up with an advanced economy like the UK. We see some steady amount of improvement in Turkey in recent years, in South Africa not so much. I don't want to spend too much time on this slide because we only have about 10 minutes left, but a brief comment on what are your expectations in terms of the damage to economic development and to improving incomes in Turkey and South Africa. Aisha, what do you think about the development path at this point for Turkey?
Right, so this is actually a graph that I really like because it shows in case of Turkey, for example, that starting from 1960 till 2000, there was no catch-up. It had stayed around 30% of UK GDP per capita all that time. And this is also true if you divide it by the US income per capita. And in 2000, there was a lot of structural reforms in Turkey. Inflation went down, and banks had become much more stronger. And you see its consequences in terms of catching up. Right now, income per capita in Turkey has really advanced relative to, started catching up. For example, with Greece, it's similar now. But of course, that's because Greece had some bigger problems during the Great Recession. If I think Turkey is due for another set of structural reforms right now, if these could happen, there's no reason for Turkey not to catch up with Spain or Greece in terms of per capita income. I think in terms of the diversity of the population and the production base, there is a lot of potential to catch up, but it is due for some structural reforms for that to happen.
What about you, George? What are your thoughts on South Africa in this dimension?
Yes, as I already mentioned earlier, economic growth has been weaker after the great financial crisis, and in the last 3 years before COVID-19, per capita GDP already started declining. I think now after COVID-19, we would probably lose 20 years per capita GDP. It will fall back to levels we have seen in 2005, and it will probably stick there as we foresee over the next 5 years growth to barely live up to the population growth rate. So like Ayesha, we need structural reforms. Unfortunately, there's quite a big, lock jam within the governing party, and it is unlikely to make the hard decisions. And therefore, we are worried that you get to a situation where circumstances or international capital forces you to make those uncomfortable decisions.
So we talked a little bit about what we expect in terms of the coming quarters, and then a little bit about sort of longer-term perspectives as well. George, you mentioned you wanted the opportunity to chat about 5 to 10 years out and what you expect in terms of growth. At the Conference Board, we make these kinds of projections as part of our global economic outlook, and they're broken up into 5-year sort of tranches of growth. So we have 2020 to 2024 and 2025 to 2029. These numbers are going to be changing, of course, over the next month or two as we take into consideration the impact of COVID-19. But what are your George? Let's start with you. What's your outlook for South Africa throughout the rest of the 2020s? How is this going to impact the economy and the trend growth?
Yes, we see trend growth coming down to about 1% over this period, and our pessimism comes from several causes. One is the supply of labor doesn't necessarily mean there will be a demand for labor. So if you have an economy where there was a big once-off fall in demand, then companies resist. They have ample capacity, and they see no need in capital investment, also not to employ more people. But for a growth perspective, obviously your labor, your productivity, both labor and capital, but especially your total factor productivity is most important. And there, I think we need some urgent structural reforms to unleash economic growth. We have the governing party is more tied towards trade unions than worried about what business people think. They are more worried about redistribution than they are worried about economic growth. And so we are therefore a bit pessimistic about whether these structural reforms will take place. But I think there are also a fair number of positives for South Africa. We have a freely floating currency. We have very low levels of foreign debt. We have also quite strong institutions, independent judiciary, independent central bank. We have the media, civil society. So there are forces pushing government hopefully to do the right thing, and they play against this being stuck. I think the biggest fear is what is happening on the fiscal side. We will probably see a jump in the public debt of 35 percentage points from around 62% to close to 100% due to this crisis. Now that is fine if you pay 1% interest, but in South Africa we have quite a high risk premium, and so you could pay easily 7-8%, and that so very painful cuts will have to be made in the short term to get our fiscal house in order.
Aisha, I want to give you some time to talk about Turkey and your long-term perspective as well. What can you tell us about the coming decade and the impact of COVID-19?
So I think, like this graph shows, Turkey has been growing with capital accumulation. What you see, the light red parts there is capital quantity, and really most of the growth in Turkey has been coming from capital accumulation. And that might have been fine for a while because it was behind in terms of its level of capital. So in the times of catching up, this may not be so strange, but eventually to grow in the future, it's going to have to be productivity. And like George was saying, total factor productivity has to be growing. And so far, the signs for its growth potential is not that high. And for that, again, we will have to go back to the structural reforms and try to make sure that you can unleash the growth potential of all the firms and small businesses in the country to accomplish that. One difference from what George was saying is that Turkish government is really keen on economic growth. And in fact, some of the problems that we're experiencing right now with low interest rates are coming from that keenness, that by increasing the credit supply and lowering the interest rates, they're hoping to diminish the effect of COVID on the economy. But it all has to be done in a very well-planned way, otherwise it backfires. But as I said before, I think in the long run, I see a lot of potential for Turkish economic growth, but the short-run risks are also quite high.
Thank you very much, Aisha. That's a great insight. We did have one more chart on external exposures, but unfortunately we've run out of time. There's always more content than time to discuss it. But before we go, I want to thank our guests very much, Aisha from USC and George from BER. Fantastic insights and perspective. Thank you so much for making the time to join us today. As everyone, as you may know, we hold the Economy Watch web series every month. It's the second Wednesday at 11 a.m. Eastern Standard Time. Next month, we'll be addressing the impact of COVID-19 on two other economies. We'll be looking at Canada and the United Kingdom. We at the Conference Board have a dedicated page for sharing all of our COVID-19 research, whether it's human capital research, economic research, governance research. It's all located in one place. Please feel free to stop by and have a look. We also welcome you to check out some of our podcasts. We do these highly frequently. And finally, we always are looking for feedback on the quality of these webcasts. If you have a few moments after we sign off here, please feel free to weigh in on how we're doing and how we can improve. Thank you again so much for joining us, and we look forward to seeing you next month.
Thank you, Eric, Ataman, George.
Thank you very much.